In today's deep dive, we are going to focus on one of the most important shifts underway in Europe right now, the rise of the automated factory. This isn't about futuristic hype, but about how robotics, AI, connected systems, and advanced manufacturing are reshaping how Europe produces, competes, and builds long-term resilience and competitiveness. We'll look at the technologies, companies, and capital flows behind this transformation, and why this industrial evolution matters strategically for investors, business leaders, and anyone tracking where Europe's real economic momentum is heading.
But before that, we're covering the top developments from January 18th to 24th, 2026. Let's jump in. The biggest funding story of the week comes from Berlin-based Clover, which secured an extraordinary $1.2 billion financing package to build what it calls an AI operating system for decentralized energy. The deal includes a $22 million Series A equity round led by MMC Ventures and QED investors, alongside a massive $1.2 billion debt facility backed by a major European bank, with additional guarantees from the European Investment Fund. Clover's platform aims to simplify and accelerate the installation of home solar panels and other small-scale renewable projects by automating workflows, handling procurement, and offering integrated financing for households. By using AI to streamline paperwork, forecast energy savings, and pre-finance subsidies, Clover wants to remove friction from Europe's energy transition. With this funding, the company plans to expand into new markets and make decentralized, energy-independent homes far more accessible across Europe.
France also had a standout week in fintech, with PennyLane announcing a $200 million funding round that cements its place among Europe's most valuable private tech companies. Founded in 2020, PennyLane offers an all-in-one accounting and financial management platform for small businesses and their accountants, combining bookkeeping, invoicing, payments, and cash flow in a single product. The round was led by growth investor TCV, with participation from Blackstone Growth and existing backers such as Sequoia Capital and DST Global, valuing the company at around $4.3 billion, according to reports. Notably, PennyLane's leadership said the company didn't urgently need capital, but saw the round as a strategic chance to bring in long-term investors while accelerating product development. The new funding will be used to strengthen AI-powered accounting features and support expansion across Europe, including a deeper push into Germany, positioning PennyLane as a serious challenger to legacy accounting software.
In EdTech, Europe welcomed a new unicorn as Preply raised $150 million in a Series D round, valuing the company at approximately $1.2 billion. Originally founded in Ukraine, Preply has built a global platform connecting learners with live language tutors for personalized one-on-one lessons. The company now works with over 100,000 tutors and students in more than 180 countries, covering over 90 languages. The latest round was led by U.S. investor WestCap and brings Preply's total funding close to $300 million. What makes Preply particularly notable is its focus on combining human instruction with AI tools that support tutors rather than replace them, while also running a capital-efficient business that recently reached EBITDA profitability. With this funding, Preply plans to invest further in AI, expand internationally, and strengthen its position as a global leader in language education, marking a major success story for European EdTech.
In software, a major cross-border merger was announced as Paris-based ABB. Tasty joined forces with India's VWO to create a global website optimization powerhouse. The combined company is expected to generate around $120 million in annual revenue and serve more than 4,000 customers worldwide, with a strong presence across Europe, the US, and Asia. AB Tasty specializes in A/B testing and personalization tools used by large brands, while VWO brings a similarly strong experimentation platform and a deep customer base in Asia and North America. While financial terms weren't disclosed, leadership of the combined group will be shared, with VWO CEO taking the top role and AB Tasty's founders leading revenue and strategy. The merger reflects a broader trend of European tech firms scaling globally through strategic partnerships rather than going it alone, creating a more competitive alternative to larger US-based players.
The UK fintech sector also saw notable M&A activity as ClearScore acquired Acre Platforms, marking its entry into the mortgage market. ClearScore is best known for offering free credit scores and financial insights to millions of users, while Acre provides digital infrastructure for mortgage brokers to manage the entire loan process. By acquiring Acre, ClearScore can now connect users who are improving their credit profiles directly to mortgage options through an integrated platform. This move follows ClearScore's broader strategy of expanding beyond credit scores into a full financial marketplace, following previous acquisitions in budgeting and secured lending. The company plans to roll out mortgage-related services, not just in the UK, but across international markets where it operates, positioning itself as a one-stop platform for major financial decisions.
Another acquisition highlights the growing importance of AI infrastructure, with US-based ClickHouse acquiring Berlin startup Langfuse. ClickHouse is widely used for high-performance analytics, and Langfuse brings tools that help companies monitor and manage AI applications in production, including performance, costs, and reliability. Founded in 2022, Langfuse quickly gained traction as demand surged for AI observability tools, and its technology will now be integrated into ClickHouse's broader analytics offering. The deal underscores both the rapid growth of enterprise AI and continued international interest in European deep tech talent, as more companies seek specialized tools to manage AI systems at scale.
Revolut also made headlines this week with a strategic shift in its U.S. expansion plans. The London-based fintech giant has decided to abandon plans to acquire a U.S. bank and will instead pursue a standalone U.S. banking license. While buying an existing bank could have accelerated market entry, Revolut now believes applying for a new license may be a cleaner and more controllable path. The U.S. remains a critical market for Revolut's global ambitions, and securing a full banking license would allow it to offer a broader range of services under its own brand. The move highlights the regulatory complexity European fintechs face when expanding internationally, even at massive scale.
Your Majesties, Excellencies, ladies and gentlemen.
Finally, one of the most important long-term developments came from Davos, where European Commission President Ursula von der Leyen unveiled the EU Inc. initiative. The proposal aims to create a single, optional EU-wide company structure that would allow startups to incorporate once and operate seamlessly across all EU member states. Key features include a unified online incorporation process, standardized investment rules, and a Europe-wide stock option framework for employees. Backed by strong support from founders and investors across the continent, EU Inc. is designed to reduce fragmentation and help European startups scale faster in competition with the US and China. While the proposal still requires legislative approval, it represents one of the most ambitious startup-friendly policy moves Europe has made in years.
And now the rise of the automated factory.
Picture a European factory in the future. Fewer fixed assembly lines, more modular cells, robots that don't just repeat motions but collaborate, autonomous vehicles gliding through aisles, and a constant stream of sensor data flowing into cloud dashboards. That's the automated factory, where robotics, industrial IoT, additive manufacturing, and AI converge into something closer to a living system than a production site. Over the past year, Europe's pace has accelerated, powered by new capital, high-stakes partnerships, and a growing sense that manufacturing capability is no longer old economy. It's strategic infrastructure. Deep tech investment numbers, rising robot density, and the spread of Industry 4.0 playbooks across SMEs all point to the same conclusion. Europe isn't just adopting the future of industry. In many niches, it's shaping it.
In this episode, we'll tour the last 12 months of Europe's industrial tech evolution through the lens of real companies, real deals, and real deployments. We'll start with the big shifts, acquisitions, mega rounds, and the venture trends that define 2025's industrial reboot. Then we'll move through the core building blocks, robots on the floor, connected systems that make factories think, 3D printing moving from prototype to production, and the rise of lights-out logistics. We'll also zoom out and map Europe's innovation clusters, from Odense to Munich to Eindhoven to Central and Eastern Europe. Because geography still matters when hardware meets talent, supply chains, and industrial customers.
The automated factory theme is bigger than a handful of robotics demos. It's the modernization of Europe's productive base, with spillover into energy resilience, defense-adjacent capabilities, supply chain security, and long-term competitiveness. It's also where AI stops being a software story and becomes a physical one, embedded in machines, operations, maintenance, and procurement. The strategic question isn't whether automation will expand, it's who captures value across the stack. The robot makers, the software platforms, the data layer, the systems integrators, and the vertical specialists. If you're investing, this is about picking where durable margins will live as industrial budgets shift from labor and downtime toward robotics, intelligence, and flexibility.
The past year delivered a clear signal. Industrial automation is now treated as a strategic asset class. The headline moment was the $5.4 billion announcement that SoftBank intends to acquire ABB's robotics division, an East-West deal that spotlights the global race for physical AI, where intelligence is embedded into machines that move atoms, not just data. Whatever you think of the geopolitics, the subtext is unmistakable. European industrial robotics capabilities are valuable enough to trigger multi-billion-dollar consolidation. It also reflects a pivot in global tech priorities. The frontier is shifting from purely digital platforms towards systems that automate production, inspection, and logistics, especially in a world where labor shortages and supply chain shocks are no longer rare events.
Venture capital followed the same logic. Robotics and deep tech automation deals pulled in hundreds of millions across Europe, spanning drones, cobots, autonomous inspection, and industrial AI. Just as important, AI became the top magnet for European venture funding in 2025, and a growing share of that AI is industrial, focused on planning, predictive maintenance, computer vision, and control systems. This is the reindustrialization narrative in investment form. Not nostalgia for smokestacks, but a bet that Europe's engineering DNA plus modern compute creates defensible companies. Meanwhile, trade groups and industry coalitions pushed for competitiveness initiatives, especially in additive manufacturing, reflecting how policy is increasingly aligned with the idea that advanced production tech is essential to European sovereignty and economic durability.
Automation is moving from incremental capex to board-level strategy. That creates opportunity, but also forces discipline. The best businesses won't just sell hardware, they'll lock in recurring revenue through software, data services, maintenance, and performance-based contracts. The big exit pathways are also clearer. Strategic buyers want capability, robotics plus AI plus integration, and private markets are warming to industrial scale-up stories that show real unit economics and long-term contracts. The macro drivers, labor scarcity, higher energy costs, geopolitical risk, and the need for resilient supply chains create structural tailwinds. The strategic edge is picking companies that can scale deployments fast, integrate into messy legacy environments, and demonstrate measurable ROI in months, not years.
Robots are still the most visible symbol of the automated factory, and Europe is evolving beyond the classic robotic arm. ABB's story, now tied to SoftBank's physical AI ambitions, reflects the next chapter: industrial robots that do more than repeat routines. The promise is adaptive robotics, systems that can perceive variation, learn from context, and handle small changes without weeks of reprogramming. At the same time, Europe's startups are pushing bolder forms. Germany's NEURA Robotics, spelled NEURA, is chasing the cognitive robot vision, mixing collaborative arms with more human-friendly form factors and sensor-rich designs intended to operate safely around people. Whether humanoids become mainstream or stay niche, the direction is clear: more autonomy, more perception, and more flexibility.
The most commercially immediate wins often come from specialized robots that solve costly, dangerous, or repetitive tasks. Zurich-based ANYbotics is a perfect example. Four-legged robots that inspect industrial facilities where humans face hazards, from oil and gas sites to power plants. Their explosion-proof model expands the market into high-risk environments that demand reliability and compliance. In logistics-adjacent robotics, Poland's NEURA scales AI-based picking and sorting, one of the hardest problems in automation because objects vary wildly and environments are messy. Meanwhile, companies like Syriac focus on the robot brain layer, giving robots the perception and grasping intelligence needed to operate in unstructured settings with less custom programming. Taken together, Europe's robotics ecosystem is splitting into categories: platform incumbents, next-gen generalists, and high ROI specialists.
Robotics returns are increasingly determined by three factors: deployment velocity, software attachment, and reliability in real-world conditions. The winners will be those who can move from pilots to fleet-scale rollouts without a giant army of engineers on site. Humanoids and headline-grabbing prototypes can attract attention, but the most defensible value often sits in repeatable use cases: inspection, picking, intralogistics, machine tending, where robots replace downtime and risk rather than simply labor. Strategically, robotics is also converging with enterprise software. Customers don't want a robot, they want outcomes: higher throughput, fewer defects, safer compliance, predictable maintenance. That shifts bargaining power toward vendors who can bundle hardware, software, and service into a performance proposition, creating recurring revenue and more resilient margins.
Automation only becomes smart when machines communicate, coordinate, and generate usable insight. That's the connected factory. Sensors on legacy equipment, edge devices collecting signals, and cloud platforms turning raw data into decisions. In Europe, momentum is accelerating because the manufacturing base is full of SMEs, companies that can't afford complex integration projects but desperately need visibility into uptime, quality, and energy use. This is why plug-and-play industrial IoT solutions have become so attractive. A startup like Hub embodies the trend. Easier kits that connect older machines to the cloud quickly, so factories can start with monitoring and expand toward optimization. The goal is not tech spectacle, it's practical digitization that works in the real world.
Across the ecosystem, industrial IoT innovation shows up in many unsexy niches that matter enormously at scale. Connectivity management, industrial safety platforms, monitoring of containers and critical assets, and digital workflows for maintenance teams. Meanwhile, corporates are driving connectivity upgrades that change what's possible on the floor. Private 5G networks promise lower latency, higher reliability, and more flexible layouts. If you can reconfigure a factory cell without rewiring, you gain agility. But the bigger story is the data layer: predictive maintenance, quality inspection via vision, and AI-driven scheduling that reduces micro delays. These gains rarely look dramatic in a demo, but they compound into real throughput increases, less scrap, and fewer unplanned stops. Exactly what manufacturers pay for.
The investor lens here is that IoT and smart factory software can be the operating system layer of industrial automation. Highly sticky if it becomes embedded in workflows. The strategic moat isn't just the dashboard, it's data accumulation, integration depth, and trust. Once a factory relies on your platform to run maintenance, optimize energy, or trigger procurement, you become hard to replace. The business models can also be more attractive than pure hardware. SaaS, usage-based pricing, and recurring service revenue, often expanded via land and expand strategies in multi-site enterprises. Holistically, connected factory systems are the foundation that makes robots and additive manufacturing scalable. For investors, the best opportunities may be in the glue layer, companies that standardize messy environments and translate industrial complexity into predictable software economics.
Additive manufacturing has moved from cool prototype to strategic production tool, especially when paired with automation and digital workflows. The modern automated factory increasingly treats manufacturing as a blend of subtractive, assembly, and additive processes, choosing the best method for speed, cost, weight, and customization. Europe has serious depth here, from machine builders to materials expertise to industrial adoption in aerospace, energy, and automotive. A story like MX3D captures the shift: robotic metal printing systems that can fabricate large components with less waste and more design freedom than traditional methods. This is not just about printing for novelty, it's about making parts that are hard or impossible to produce efficiently through conventional manufacturing.
Startups across Europe are also attacking the bottlenecks that will determine additives' scale: reliability, quality assurance, post-processing, and new materials. These are the problems that matter when you move from one-off parts to repeatable production. On the corporate side, the pattern is clear. Aerospace prints lightweight components, energy companies print and repair critical parts faster, and automakers print tooling, jigs, and customized elements that reduce lead times. A subtle but important shift is inventory logic: digital inventories replacing physical stock, with parts produced on demand closer to where they're needed. That's not just a manufacturing improvement, it's supply chain redesign. Policy momentum adds weight. Europe's industry groups are explicitly framing additive manufacturing as a competitiveness pillar, pushing coordination and workforce development to avoid fragmentation.
Additive is attractive because it creates multiple value pools: machines, materials, software, certification, and distributed manufacturing services. The most defensible companies tend to own either a process advantage, a critical material ecosystem, or software that integrates additive into mainstream production planning. Strategically, additive manufacturing matters because it increases resilience and optionality. Faster prototyping, localized production, lighter and more efficient components, and shorter repair cycles for critical infrastructure. That translates to tangible ROI in industries where downtime is expensive and where supply chain disruptions are existential. From a portfolio perspective, additive also complements robotics and IIoT. Once you have connected factories and automated workflows, additive becomes another programmable production module. The long-term investment thesis is about flexibility as a competitive moat.
The automated factory doesn't stop at the production line. It extends into warehouses and supply chains that increasingly operate with minimal human intervention. Europe has become a major innovation engine for warehouse automation, driven by high labor costs, dense consumer markets, and the relentless demand for faster fulfillment. Exotec is a prime example of European scale-up execution. Robot fleets that retrieve goods from high-density storage, with next-generation systems improving throughput, storage utilization, and picking efficiency. The excitement isn't just the robots moving fast, it's the operational impact. Fewer errors, shorter order cycles, and the ability to scale capacity without scaling headcount in the same proportion. That's why warehouse automation budgets keep growing even when other CapEx categories tighten.
Alongside the big names, Europe is producing high-value specialists. Dexery's model, autonomous inventory scanning, plus a digital twin view of warehouse reality, targets one of the most painful operational gaps: knowing exactly what is where in real time. That seems mundane until you realize how many businesses lose money on mispicks, stockouts, and inventory blind spots. In parallel, AI picking firms like NEURA push the frontier of robotic manipulation, which remains one of the hardest engineering and commercial problems in automation. The industry is also moving toward integrated solutions, partnerships that connect tote handling, pallet movement, and warehouse orchestration under one system. Customers don't want isolated automation islands. They want end-to-end flows that reduce friction from inbound receiving to outbound shipping.
Logistics automation is compelling because revenue can scale quickly through large enterprise contracts multi-site rollouts, and long-term service agreements. But it's also competitive, so differentiation matters. Deployment speed, measurable throughput gains, and interoperability with existing warehouse management systems. Strategically, lights-out logistics is a force multiplier for manufacturing, reducing buffer inventory, improving responsiveness, and protecting companies from labor volatility. It also ties to ESG in a practical way. Less waste, smarter routing, and better utilization of space and energy. Holistically, supply chain automation turns manufacturing into a more predictable, data-driven system, and predictability is what markets reward. The companies that become default platforms in intralogistics can capture durable value because they sit at the intersection of operations, data, and recurring upgrades.
Industrial revolutions don't happen evenly, they cluster. Europe's automated factory story is powered by ecosystems where talent, customers, research, and capital collide. Odense, Denmark stands out as a flagship. A robotics cluster with deep roots in academia-industry collaboration and a track record of producing globally relevant companies. Germany's hubs tell a different story. Munich for deep tech and AI-driven industry, Saxony for hardware and IoT pragmatism, and regions like Stuttgart anchored by industrial incumbents that act as both customers and venture partners. The Netherlands' Brainport Eindhoven shows how precision engineering cultures spawn spillovers into automation, additive, and advanced systems. And Switzerland's mix of research, manufacturing rigor, and capital has helped companies convert deep engineering into deployable products.
Central and Eastern Europe adds another layer. Strong engineering talent, increasing access to global capital, and a growing record of exit activity through acquisitions. These regions often produce specialists in machine vision, robotics components, or industrial software, built close to cost-sensitive customers who demand practical ROI. Meanwhile, cities like London and Paris play a different role. Financial, regulatory, and partnership hubs where industrial tech companies connect to international investors, corporate clients, and talent. Surrounding all of this is an infrastructure of accelerators, digital innovation hubs, and EU-backed programs that help SMEs test technologies before committing major budgets. The invisible work, pilots, test beds, training programs, often determines whether automation diffuses broadly or stays trapped in the top tier of large corporates.
For investors, clusters are both signal and leverage. Signal because ecosystems with dense talent and repeat customers tend to generate more investable companies. Leverage because clustered adoption reduces sales friction and improves pilot-to-scale conversion. Strategically, Europe's advantage is that these hubs are networked rather than centralized. Multiple nodes with specialized strengths, linked by cross-border collaboration, research partnerships, and shared industrial standards. That creates resilience. Innovation doesn't depend on one city or one sector cycle. From a portfolio standpoint, understanding where each hub excels helps investors place smarter bets. And the holistic lesson is that Europe's automated factory story is also a map of competitive ecosystems, and value accrues where ecosystems repeatedly turn prototypes into deployments.
Over the last year, Europe's automated factory narrative has shifted from promising to concrete. We've seen major deals that validate the strategic value of European robotics, capital flowing into deep tech companies that solve real industrial pain, and a steady march toward connected, data-driven operations. The robots are getting smarter, the software is getting stickier, and the manufacturing base, especially SMEs, is increasingly able to adopt automation without massive integration pain. Additive manufacturing is strengthening Europe's flexibility, and warehouse automation is turning supply chains into faster, more predictable systems. These aren't isolated trends, they reinforce each other, turning automation into a system of systems rather than a collection of tools.
Looking forward, expect more consolidation and more stack building. Industrial incumbents will keep acquiring AI and robotics capabilities, while scale-ups will broaden their offerings to become platforms rather than point solutions. We'll likely see more performance-based contracting, vendors paid on outcomes like uptime, throughput, or defect reduction, because it aligns incentives and reduces customer adoption risk. Skills will be a decisive bottleneck. The winners will invest in training, deployment playbooks, and partner ecosystems that accelerate adoption. And as regulations around AI mature, Europe may lean into reliability, safety, and compliance as global differentiators in industrial AI and robotics.
The strategic takeaway is that automation is becoming Europe's growth infrastructure, capable of compounding productivity, strengthening supply chain resilience, and enabling competitive manufacturing even under high-cost conditions. The most attractive opportunities will sit where value persists. Platforms with recurring revenue, deep integration, high switching costs, and proven ROI. The automated factory matters because it changes the unit economics of making things in Europe, reducing downtime, improving quality, and enabling faster reconfiguration when markets shift. That's not just a manufacturing story, it's a competitiveness story with direct implications for earnings, margins, and economic resilience.
If you like this episode, like, share, and follow us. Thanks for joining us in this episode of Eurotech. Have a great week.